Hey, it's Owen here with Owen Finance, your gateway to smarter investments, sharper financial insights, and also the ever evolving world of crypto and much more. Ready to level up your financial game? Let's dive in. Imagine you're looking for ways to grow your money and you keep hearing about stocks as a cornerstone of investment portfolios. That's because owning shares of a company can potentially help you build wealth over time. In this video, we'll break down exactly what a stock is, why it matters, and what you need to understand before you dive into the world of equity investing. We'll look at the basic definition of a stock, the motivation behind companies issuing shares, the different types of stock, what influences share prices, the risks and advantages of investing, and some suggested next steps if you're ready to learn more. First, let's explore why stocks attract so much attention in the investment world. From large, multinational corporations to smaller, fast-growing startups, stocks serve as a gateway for investors to share in a company's potential success. They're one of the most straightforward paths toward partial ownership of a business. If that business flourishes, shareholders can see impressive gains through price appreciation and possibly dividends. If the business struggles, shareholders bear the brunt of losses. This dynamic, while risky, is also what makes stocks so compelling. There's the potential for higher returns compared to many other investments. A stock, at its core, represents ownership in a company. When you buy a share, you're effectively purchasing a tiny slice of that company, which gives you certain rights. In most cases, you have the right to vote on major issues, like electing a board of directors or approving big corporate decisions. You also get a claim on a portion of any future earnings, usually in the form of dividends, if the company chooses to distribute them. Think of it like being a partial owner of a pizza shop. If the shop does well, you might receive your share of the profits at the end of the year. If it doesn't, there may be less or no profit to distribute. The concept is the same with stocks, only on a much larger scale. Now, why do companies issue shares in the first place? Typically, businesses need capital to grow, whether that means expanding into new markets, developing innovative products, acquiring other companies, or hiring more staff. One way to raise that capital is by borrowing money, like taking out a loan or issuing bonds. Another way is by going public, which means listing on a stock exchange and offering shares to outside investors. This process is known as an initial public offering or IPO. When a company goes through an IPO, it's basically selling a piece of itself in exchange for cash it can then use to fund its operations or growth plans. In return, the shareholders expect that if the business thrives, the value of their shares will increase, or the company will pay dividends. However, once a company is publicly traded, it also takes on new responsibilities like disclosing financial statements and complying with market regulations. So, issuing stocks can be a powerful funding tool, but it comes with increased scrutiny. There are different types of stocks that cater to different investor needs. The most common is known simply as common stock. With common stock, you often have voting rights at shareholder meetings, and you might receive dividends if the company distributes them. In contrast, preferred stock typically provides a more predictable dividend, but usually doesn't come with voting rights. Preferred shareholders also have priority over common shareholders if the company goes bankrupt, meaning they get paid out first if the assets are liquidated. Beyond these broad categories, you might also hear about other classifications, such as growth stocks, companies that reinvest earnings to expand rapidly, value stocks, companies seen as undervalued by the market, or dividend stocks, companies that regularly distribute a portion of their profits. Each category presents its own risk-reward profile, so knowing the differences can help you align your choices with your investing goals. Next, let's consider the factors that influence a stock's price. At any moment, a share price is essentially the market's collective opinion of the company's current worth and future potential. A company's financial health, how profitable it is, its debt levels, and the strength of its management team can heavily influence its share price. If a business consistently reports strong earnings and shows growth potential, investors may be willing to pay more for its shares. On the macroeconomic side, interest rates, inflation, and overall economic growth can sway investor sentiment. Lower interest rates might encourage people to invest more in stocks because the returns on savings accounts or bonds could seem comparatively low. Conversely, if interest rates rise, some investors might shift money out of stocks to take advantage of safer, higher yielding investments. Market psychology, how optimistic or pessimistic investors feel, also plays a big role. News stories, rumors, or geopolitical events can spark sharp buying or selling waves, pushing prices up or down regardless of a company's fundamentals. Ultimately, share prices fluctuate because the market is always interpreting and reinterpreting new information about both the company and the broader environment. Investing in stocks comes with both risks and rewards. On the reward side, stocks have historically offered some of the highest returns compared to other asset classes like bonds or cash. Over the long term, the stock market's upward trend can provide opportunities for capital appreciation. Some stocks also pay regular dividends, offering a source of passive income. Being a shareholder can be fulfilling, too, particularly if you support the mission or products of the company. However, there's a flip side: volatility. Stock prices can soar one day and crash the next, influenced by factors well outside a company's control. Market downturns can lead to large losses if you sell during a panic. Individual company risk also matters. If a business fails, shareholders can lose their entire investment. Diversification, or spreading your money across different stocks, sectors, and even asset classes, helps mitigate these risks, but never eliminates them completely. Understanding both the potential upside and the downside is essential before committing your capital. In summary, stocks represent ownership in a business. Companies issue them to raise money for growth, investors buy them hoping for profits through price gains and dividends, and a stock's price moves up or down based on a blend of company performance, economic conditions, and market sentiment. While the potential returns are appealing, it's crucial to recognize the risks and learn about strategies to manage them. A smart first step could be opening a demo account with a reputable broker or reading more about fundamental and technical analysis to get a feel for how stocks behave. Building a diversified portfolio that aligns with your goals and risk tolerance is also key. In upcoming videos, we'll explore how to evaluate a company's fundamentals, how to choose the right platform for trading or investing, and how to craft an investment strategy that suits your financial objectives. Ultimately, the world of stocks can be a powerful avenue for growing your wealth, provided you approach it with knowledge, patience, and a clear plan.
Thank you for watching. If you liked the video, don't forget to give a like and subscribe to support us. If you are interested in our premium content, please also visit our Patreon. You can find the link in the description. Thank you, and take care of yourself and your finances.